Hey everyone, welcome back to The Explainer. So if you've ever stared down a massive mountain of student debt and just wondered how to actually make the tax code work in your favor, well, you are definitely in the right place today. We're taking a real-world tax computation puzzle straight out of a CA intermediate income tax law compiler, and we're going to break it all down. All right, let's just dive right into this. We'll be looking at a gentleman named Mr. Sarab. He's currently juggling multiple education loans, and we're going to use his specific scenario to really demystify Section 80 of the Income Tax Act. By the time we wrap this up, you'll know exactly how to navigate this particular tax deduction. Let's get to it.
11 lakh rupees. I mean, wow, that is a heavy financial weight, right? This massive number represents the combined principal amount of 3 totally separate education loans that our protagonist, Mr. Saurabh, took out on April 1st, 2025. When you're managing that level of debt, every single rupee you can save on taxes matters tremendously. But as we all know, tax laws are notoriously tricky, and making assumptions can be incredibly costly.
Which brings us to the ultimate tax planning question we've got to solve today. Out of that intimidating 11 lakh rupee total, how much of it can actually trigger a tax benefit for Mr. Saurabh? The answer isn't quite as straightforward as you might think. It requires a really careful reading of the law and a very specific filtering process, which we are going to walk through together using our source material.
Section 1. Meet Mr. Saurabh and the financial burden.
Okay, let's break down these 3 loans from our source case study. Loan 1 was taken for an individual referred to as B to pursue an MBA. That one is 5 lakhs total, with a pretty heavy annual principal repayment of 1 lakh. Loan 2 is for B's son's BSc, coming in at 40,000 annually. And finally, Loan 3 covers B's daughter's BA with an 80,000 rupee annual repayment. If you add all those up, Mr. Saurabh is shelling out 2,20,000 rupees a year just toward the principal. That is a massive cash outflow.
Moving on to Section 2. The Section 80E rulebook. So the absolute most crucial point here is this very first hurdle. According to our source material, the deduction under Section 80E is only available to an individual SSE who pays tax under the optional tax regime. You literally have to actively exercise the option to shift out of the default tax regime provided under Section 115 BAC 1A. Think about it. If Mr. Saurabh just sits back and stays in the default regime, none of the rest of our calculation even matters. His deduction would just be 0. For our computation today, we're going to assume he's smartly shifted to the optional regime. Next up, we need to verify the type of education. The law specifically defines higher education as any course of study pursued after passing the senior secondary examination, or its equivalent. Looking back at Mr. Saurabh's loans, we've got an MBA, a BSc, and a BA. All 3 of these are post-senior secondary degrees, so they all pass this filter flawlessly. Now, you might be wondering, who exactly can you take a loan out for and still get this tax break? Well, the law restricts eligible beneficiaries to the individual themselves, their spouse, or their children. In our case study, the loans are for B, which in this context represents the individual or their spouse, the son of B, and the daughter of B. Therefore, all the individuals listed here fit perfectly into the legal definition of eligible beneficiaries. And here is where we see a really common taxpayer trap. Repaying 2,20,000 rupees a year feels like this massive deduction opportunity, right? But under Section 80E, the principal repayment, like the actual loan amount you're paying back, is completely irrelevant. The deduction is strictly in respect of any interest paid in the previous year. Section 3. Crunching the numbers. So, if we look closely at the original source material from the CA intermediate compiler, right underneath that initial table is a separate row, kind of tucked away. It's labeled Annual Repayment of Interest. This right here is where our critical tax-saving numbers are actually hiding. We have to completely ignore those large principal amounts we talked about earlier and focus exclusively on this specific row. Let's just isolate those exact interest numbers so they are crystal clear. Based on our updated understanding of Section 80E, these are literally the only numbers that matter for our calculation today. For Loan 1, the MBA, the interest is 20,000 rupees. For Loan 2, the BSc, it's 10,000 rupees. And for Loan 3, the BA, the interest paid is 18,000 rupees. Let's do a quick step-by-step verification just to guarantee Mr. Saurabh's claim for the assessment year 2026-27 is totally bulletproof. Step 1, optional tax regime assumed. Check. Step 2, higher education. Check. Step 3, eligible beneficiaries. Check, which leaves us with step 4, simply summing up the eligible interest we just isolated.
And that brings us to section 4, the final tax deduction.
So, we're literally just adding up the interest from these 3 qualifying loans. That is $20,000 from the MBA, plus $10,000 from the BSc, plus $18,000 from the BA. It becomes a really straightforward addition problem now that we've filtered out all the noise of those principal repayments. And boom, there is our final answer. 48,000 rupees. That is the exact amount deductible under Section 80E for Mr. Sarab for the assessment year 2026-27. Out of that massive 11 lakh rupee initial loan burden, and despite those super heavy principal repayments, it's this specific 48,000 rupee interest payment that actually translates into a tangible tax deduction. We have successfully solved the puzzle.
You know, this explainer really highlights just how precise you have to be with tax planning. Mr. Saurabh's situation teaches us a vital lesson. Knowing what you are paying is absolutely just as important as knowing how your tax regime actually treats it. So, I want to leave you with this final critical question to consider for your own finances. Are you absolutely sure you're in the right tax regime to claim your deductions? Don't let a default setting cost you money you legally deserve to keep. Thanks for joining me for this explainer. Keep learning, and I will catch you next time.